Hi guys, how are you? Welcome to Real Macroeconomics and Investing. Welcome to TradingView, YouTube, and to my subs. How you guys doing? How you doing? So, what's going on hither? Well, everybody wanted the bottom. They got it. They didn't like the bottom. Crazy people. Yeah, well, that's why I say don't uh, try to pick bottoms. Don't do it. Save yourselves. Um, Well, obviously, I'm not going to post any kind of trades, so I'll focus more on macro. Okay. Um, where do I begin? All right. I kind of want to talk about the new home thing here, but I think before I talk about the new home thingy, and this is new home, new. Okay, it's not all homes. I think I'm going to go a little bit back in time, and I'll start with commodities. Okay. Now, if you go back on April 28th, 2021, and you see this chart, I'm going to say, hey, be careful. We are breaking out and we're likely going to see the next move higher. What does that mean? Well, it means the commodities are going to rise, which is going to uh, it's going to produce inflation. Okay. And I have this whole big explanation here, blah, 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 and whatever. Fast forward 8, 9 months, whatever it's been since then, and here we are with inflation. Now, let me make this clear. There is absolutely no politician, I don't care left, right, who you vote for. Political economic theory doesn't mean anything to me. I don't care about politics. But there's no politician on either side that is going to admit that they just printed too much damn money. Period. They're not going to do it. So they gave you two choices to pick from: transitory or supply chain. Those are symptoms. Those are not causes. So, how can I say that with certainty? Well, first of all, let's examine why commodity prices rose in the first place. And we're going to go back and we're just going to have a little mini lesson here. Government deficits go into the productive economy and they pump money into this economy. And then the household is going to dissave it. Household dissavings equals profit. Profit is what? It equals savings. Savings is not going to go underneath a mattress, and it's going to go into asset prices: stocks, bonds, commodities, real estate, and crypto. And then you end up with asset price inflation. You understand how that works? The everything bubble, as they say. And it all comes back from governments printing money to try to keep the economy going. Now, why would anybody go out and buy commodities? Well, you wouldn't buy commodities. You would buy stocks. You would buy real estate. Interest rates are very low. You would buy bonds. Okay. The thing with bonds are they're a little bit funky. A lot of people don't understand them, but it all starts there. So, in order to understand bonds, think about it like this: when bond prices are down, think of a seesaw. Okay. When bond prices fall, interest rates rise. Okay. How about the opposite? When bond prices are high, interest rates fall. Okay. When interest rates are offered at 0% and you have bond prices at all-time highs, they are essentially the same as a commodity. Both are not offering you any kind of interest rate or yield or anything. They're just zero. It's just whatever the price is. That's where you make money. So think of it like this. Why would you go out and buy a bond that is historically high and not go out and buy a commodity that is at 13-year lows? Right? So you say, you know what? I got a little bit of extra cash. I'll start pumping a little bit of money into commodities because I think they have some upside because they've been falling for, 13 years. And then you end up here at a key area. And then I come along and I'm like, hey, look, this is bad. Bad. Why? Why is that bad? Because we're going to end up with inflation. Why? Because of money flows, excessive deficits from government that went into savers, and savers are now saying, hey, let me go buy some commodities. Now, remember this, that commodities is a very small market relative to everything else. Okay? So when there's more buyers and sellers, and everybody's piling into that undervalued asset class in commodities, you end up with commodity inflation. And guess what? 8, 9 months later, I'm right. I'm right. And what do we end up with? We end up with inflation. But everybody's telling me it's transitory, it's supply chain, it's Biden, it's Trump, it's whatever. At the end of the day, you have inflation. Okay? And the reason you have inflation is because the bond and a commodity are trading at the same coupon, zero interest rate. So you end up with asset price inflation in commodities and then real world inflation. Raw materials start to rise. Buffett comes out and says, hey, we have an inflation problem. Everybody's like, what? He's a kook. He's crazy. He's so old. Why anybody listen to him? Well, you better listen to the old kook. He may be 93, whatever he is, 100 years old, and maybe forgot to die, but that guy knows what he's talking about. And if you go back to the shareholders meeting, you listen to that, hey, we have an inflation problem, and you'll see how important that was and what a great call it was. So now, why does this matter? Well, it matters because it affects everything. You see, commodities are the great equalizer. You can print, you can do all sorts of crazy stuff. But when commodities start to rise and you cause inflation, well, inflation starts making everybody else, you know, uh, very nervous. Very, very nervous. So let's go back now to junk bonds. And let's think about junk bonds. We're going to kind of go backwards here. January 5th, I said, oh, we're breaking key area, be careful, right? This is not necessarily a trading signal. This is a macro call, okay? A lot of people get that confused. Be careful, it's breaking the key area. Next likely move is to the downside. Guess what? It was. So why does this matter? Well, because companies that are in junk territory don't have pricing power, okay? And now the cost of borrowing for them has just went up. So they can't pass it off to customers. They don't have pricing power. They have their raw materials rising. They got unit labor costs rising because of inflation. And now they can't roll over their debt or issue new debt without paying more uh, to acquire that debt. If they can't make the company survive, guess what? You blow up. You blow up, you're going to have an unemployment problem. Because if everybody starts blowing up, you end up in a recession. Which is usually, by the way, what happens when you have high inflation. Every other time in history, when you had high inflationary periods, you ended up with a recession. I don't think this time is going to be different. I could be wrong. My analysis could be wrong. And I don't know. But I'm going to tell you that's the way I'm going. I think there will be a recession at the end of all this. And then all these people that are like, hey, supply chain is transitory. Don't worry about the inflation. They'll be like, haha, see? Yeah, haha, see? But you ended up in a recession. You see? It's remember, people are going to give you all different kind of glasses to put on in different shades and look at it this way and put this lens here and look at it that way and look at it. Everybody's got some angle they're working. At the end of the day, if you are like I am, I only care about the data and whatever it says, and that's what it is. And I don't care what anybody says. Well, you get to see things a lot clearer. You don't worry about the politics. Political economic theory doesn't work. I'll tell you that much. So that's the implication for money flowing into commodities, which causes inflation, which causes interest rates to rise, which causes companies with no pricing power to start to blow up eventually as rates start to rise. And remember, it's the rate of change that matters. You go to high inflation countries, they've learned how to live with it. Okay, you go from a country that has very low inflation and then suddenly it starts to pop and people are not ready for it, you end up somewhere where you don't want to be. Now think about this, that as you have higher interest rates, okay, you are going to spend more money trying to service debt, uh, which means you're not going to be consuming. And if you're not consuming, guess what? The economy starts to contract, recessionary. Uh, let's get back to housing now. Okay, this is new home prices. Okay, let's be clear. It's not all homes. It's just new home prices dropped 10% in 2 months. Well, if you compare that to the great financial crisis, new home prices dropped 22%, but it took a few years, 2, 3 years. We did 50% of this move in 2 months. And people are like, oh, don't get your panties in a bunch. What? What? Oh, it's just a correction. What? You lost 10% in new homes in 2 months, and it's like, oh, don't worry about it. La 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 la. No, pay attention to it. Well, I'm not trading it. Well, I didn't know there was a ticker you could short new home prices. There isn't. This is a macro call. Okay, so some people are just funny. Now, if you look at 2000, the dot-com bubble, and market went to the shit. What happened to new home prices? And I keep saying new, right? What happened? Well, it just like nothing happened. It just kept going up and it actually even accelerated, right? Until the great financial crisis. But um, this is something you should definitely pay attention to. You can't lose 50% of what you lost in 2008 in 2 months and be like, oh, don't worry about it. Just a correction. No, no. You should pay attention to it. Doesn't mean you run out and make all kind of irrational decisions and investments and trades as a result of it, but it's a piece of the puzzle. And it's important. And you should pay attention. All right. Somebody's like, well, I'm going to go out and buy banks. Why? Why would you buy banks? Like, I want to see the logic. Because rates are rising. That's good. They're going to charge more money. They're going to make a boatload of money. No, 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 no. That's not the way it works. Uh, Remember, if that worked like that, well, banks should have been making boatloads of money back in 1980. You should go out and buy Turkish banks. In fact, you should go buy Lebanese banks or Sri Lankan banks. That's not the way it works. Remember, it's a ratio. Okay, it's a ratio. So this is the ratio. When banks pay interest on the short end of the curve, which is 2 years or less, and they make loans at 10 years or more. If the short yield is higher than the long yield, that's not profitable. And that's what you see in this chart. And this chart should scare the shit out of you because it's collapsing. Okay? We're going to a recession signal. When it's going straight up, that's good for banks. That's when you should be buying banks because the spigot is wide open. The profitability is maximized. Okay? They're paying very little on the short end, 2 years or less in interest, and they're making loans at a very high rate. It's a steep yield curve. And that's when they make the most amount of money. It's not that, hey, higher rates is good for banks. No, it's actually bad, as you can see for now. Right? In fact, they've gotten even worse. And that's why, and I don't know why this is still here. I didn't even see it. Sometimes I don't look at things, but I said, look, this was back here. Huh? I was saying, look, there's no recession this time around. Huh, that's a joke. Every other time it was a recession, and this time it's not. Lol. Ha ha ha. And sure enough, look what happened. Boom, recession. Well, you were lucky it's COVID. No. Google it. The U.S. entered a recession in February of 2020, before COVID. We were already in a recession. And remember, by the time we acknowledged that February was a recession, we were already in recession before that. So we are rapidly heading towards a recession, but this time we're raising rates into a recession signal. We are going to, quote unquote, spend less going into this recession. Okay? It's completely opposite from the way we've been doing in the past. Well, if you're going to have less deficits and you're going to be raising rates into a recession, and you're going to make the cost of borrowing more expensive. Well, guess what? It's going to affect homes. Now, homes are a little funky. We can get really in depth with this stuff. The balance sheet of borrowers today is much better than it was 2008. It's not the same animal. I don't want to panic anybody. But at the same time, you cannot tell me that higher rates are going to be good for, banks. They're not. Nobody's going to run out and say, you know what, I'm going to refinance at a higher interest rate. That's not going to happen. Okay. The profitability margin right now is very low for banks. That means tighter lending standards. We're not heading in the right direction. Got to be really careful. Don't try to pick bottoms. Okay. You pick bottoms and, people are going to run out and buy the dip, right? That's what they've been trained to do for the last 12, 13 years. And you're still going to have that crowd. And every time they're going to buy the dip because they will it, they're going to spread all this information all over social media, get everybody excited to go out to buy the dip. And then as soon as they buy the dip, they don't like it. And then we're going to make a new low. And then they're going to say, oh, no, this is the dip. This is the bottom. And then they're going to run out. And they're going to do the same thing. And then it's going to go lower. Right? No, this is going to be and then they're going to go lower until eventually they give up and there's no more buy the dip crowd and everybody hates it. And there's only now short the rip crowd, which is ultimately going to resolve into some kind of bottom. So be careful. Be careful, please. Be cautious. I'll be here with you guys. I'll try to give you the best information I can. Please don't ask me where the bottom is or how deep something is going to go. I don't know. Don't have a crystal ball. But that's the macro lesson for today. A little bit on charting, a little bit on psychology. Be careful. Thank you very much. Don't forget to look at these past videos. I think they're very useful. I think there's always something to be learned. And great to see more followers. This is fantastic. Almost to 1,900. Go, 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 go. I'm always going to work hard to help you in any way I can. Remember, this is my diary. I can't give you all the information, but I can certainly guide you. Thank you very, very much. You guys are awesome. Have a great trading week. Sayonara. Bye-bye.